Hi, I'm Grant Mundell, investment specialist from Equity Trustees with our investment market update for May. Investor returns rose strongly in May, fueled by equity market gains. Equities rallied strongly as trade and tariff tensions eased. The risk on trade following President Trump's tariff pause in April continued in May. Many equity markets are now nearing all-time highs again. During the month, tariff rates on China were lowered and EU tariff rates were lifted to 50% and then reversed back to 10%. In addition, the Trump administration announced the One Big Beautiful Bill encompassing tax reform. Global equities had its best month since November 2023. In local currency terms, the ASX 200 rose 4.2%, the US S&P 500 jumped 6.2%, Europe rebounded 5.4%, and the Japanese Nikkei rallied 5.3%. One of the key features within equity markets was the strong performance of tech stocks. Notably, the tech-laden Nasdaq was one of the strongest markets, rising 9.6%. Sectors leveraged to economic growth outperformed, while defensive sectors such as utilities, healthcare, and consumer staples lagged. In the US, economic data is slowing but has been reasonable. However, soft data indicators such as consumer sentiment are weak. There remains strong debate about whether the reasonable hard data will converge towards what the weaker soft data is indicating. Notably, there has been a pull forward of demand due to the potential imposition of tariffs, which has muddied the economic outlook. Manufacturing data has stabilised while services have fallen. Inflation expectations in the US have risen, highlighting concern about future tariff rates. Higher inflation risks will complicate the outlook for the US Fed. Consensus expects the US economy to slow to around 1.5% growth over the next year. US government bonds are a key focus for investors given fiscal concerns. Bond yields have continued to edge up over the last couple of months. Meanwhile, the US dollar has remained under pressure as international investors have reduced their holdings in US assets. China's two-speed economy has continued, with manufacturing and exports remaining resilient, while activity in the real estate market and consumer sector remains subdued. Trade flow from China to the US has fallen dramatically, while trade flow elsewhere has picked up. However, new export orders are starting to soften. Many expect Chinese economic growth to continue to slow to around 4% over the next 12 to 18 months. The European Central Bank and Bank of England have continued to cut rates given weakening economic momentum and well-behaved inflation. Economic growth is expected to improve in Europe next year but remains fairly tame. In Australia, the Reserve Bank cut rates another 25 basis points to 3.85%. The RBA comments were more dovish than the market thought, and many expect around 3 more rate cuts this year given tamed inflation stats and impending global economic risks. Importantly, Australia remains less directly impacted from US tariffs, while the indirect impacts are less well known. Economists forecast Australia's GDP growth to improve to around 1.8% this year and 2.3% next year. Corporate credit spreads tightened, supported by the risk-on rally and strong investor demand for credit. Demand for new issues was also very strong, supported by a solid backdrop of reasonable economic growth and falling interest rates. Despite the rally in equity markets, earnings revisions remain flat to down. ASX earnings were revised down again in May. This means the valuation of the Australian share market became even more expensive and ended the month trading at 18.8 times 12-month forward earnings. That compares to the 15-year average of around 15 times. Despite the encouraging directional moves, there remains considerable uncertainty about where tariffs will land, which is likely to weigh on corporate investment and near-term global economic growth. US average tariff rates are currently sitting at around 15% versus 2.5% at the beginning of the year. Given these headwinds, we find it hard to justify current equity market valuations. The dividend yield for the ASX 200 is now around 3.4% pre-franking, which is well below the long-term average of 4.5% and also sits below the Australian 10-year bond yield of around 4.3%. We therefore retain our small tactical underweight to equities and our small overweight to defensive assets. I'll see you again next month.